Let's move on to this particular question. Corporate and Management Accounting, paper 2, International Advanced Level, Unit 2, Corporate and Management Accounting. Okay, so the question number 2, this is relating to net present value, the payback period and average rate of return. So let's go through the question and then we'll try to solve this question. HJK Storage PLC is a company that has a number of warehouses that provide storage space to customers. HJK Storage PLC is considering increasing the number of storage spaces by building 5 new warehouses. Okay, so they are going to increase the warehouses to 5. HJK Storage has been told that the government will take over the land on which the warehouses are built in 5 years' time. So therefore the period is the 5 warehouses and the project life is also 5 years. To build a motorway, HJK Storage will receive no money as compensation from the government. The following information is available for each of the 5 new warehouses. Okay, so you are given the storage space sold and occupied yearly from year 1 to year 5 is given, and also charge per week for a storage space sold and occupied. Okay, so you are given the charges per week per storage, and also you are given the running cost per week per storage space occupied excluding the depreciation. And also the following information applies to 1 new storage warehouse. The cost of building 1 new warehouse will be £100,000. So this is the cost of building new warehouse. Cost is 100,000 per warehouse. Since we are going to build 5 warehouses, so therefore that the total cash outflow will be 500,000. 100,000 times 5 will be 500,000. 1 new warehouse will have 80 storage spaces, so that can be given on rent. Okay, so where that will be charged per week, yearly, the rates are given separately. 1 new warehouse will have 80 storage spaces. Depreciation per warehouse is expected to be 20,000 per year. Okay, so this is per 1 new storage warehouse. Okay, so depreciation per warehouse is 20,000 per year. So if you take 100,000 is per warehouse cost divided by the useful life is, the project life is 5 years. So therefore it is going to be 20,000 per year. Assume 52 weeks in a year. Okay. The company policy is to have a positive net present value on projects within 5 years. So this is how you evaluate whether the project is feasible or not. The cost of capital of the company is 10% and also the discounting factor table is given. The first question is calculate the net present value of the project to build and operate the 5 new warehouses at the end of 5 years. Okay. So first of all we need to identify the cash inflows and cash outflows. Okay. So let's identify the cash inflows and cash outflows. So year 0, there is a cash outflow of 500,000, which is 5 warehouses times 100 per warehouse. The total is going to be 500,000. This is the cash outflow. So year 1, we need to identify what is the total cash inflow. To calculate this, you are given these storage spaces, the charge per week and the running cost. Okay. So let's identify the revenue. First of all, we'll identify the revenue. Yearly revenue, which is storage space sold and occupied 50% in the first year. 50% in the first year. Charge per week is £35 times 1 new warehouse will have 80 storage spaces. So 80 this storage space can be given on rent, on which £35 can be charged. In the first year, the occupancy ratio is 50%. Out of 80, 50% will be occupied, which will be charged 35 pounds per week, and there are 52 weeks. Okay, so therefore we need to calculate. So let's calculate the revenue for the first week, which is 35 for first year. 35 times 80 times 52 weeks times 50% times 5. Yes. So here we have to take 50% is the occupancy ratio, 80% is the storage space given on rent, 35 per week. There are 52 weeks and there are 5 stores. Okay. So therefore, your total revenue for the first year will be 364,000. Year 2, the occupancy ratio is 75%. The rate is rate 35, same rate, and there are 80 storage spaces times 52 times 5 storage warehouses. So when you take 80 times 75 times 35 times 52 times 5, which is going to be 546,000 revenue. Okay, so this is revenue. Then third year, year 3, the occupancy ratio is 80%. The rate is going to be 37, 80 storage spaces, 52 times 5. Year 4 will be 85% occupancy ratio, 90% occupancy ratio, and the rate is going to be the same rate, 37, 80 storage spaces, 52 weeks times 5. So let's calculate the revenue. Year 5 is going to be 95%. The rate is going to be 40 times 80 times 52 times 5. That is for year 5. So let's calculate these numbers. This is 615, 680 and 692, 640, and year 5 is going to be 790, 400. Okay, 790, 400. So this is the revenue. Then we need to identify the cost. What are the costs? Running costs. So running cost is given $5 per week per storage, excluding depreciation. So since we are going to calculate the net present value, we don't consider non-cash items. So depreciation is a non-cash items that will be considered when you calculate the average rate of return based on the profit. So when it comes to cost, it's already deducted the depreciation. So therefore what you need to do is you need to continue this calculation. This is the common factor, 50%, 80 storage spaces, 52 weeks and 5 storage spaces. Instead of 35, this is the revenue, we need to take $5. Okay, so 50%, 80 storage spaces, $5 times 52 weeks times 5. Okay, so we need to continue this calculation. 50 times 80 times 5 times 52 times 5, which is going to be 52,000. 52,000. Okay, so the second year is going to be same calculation, 75 times 80 times 6 is the cost, running cost, 52 times 5, we need to identify the cost. Then the year 3, 80%, 80 times, the rate is 7 pounds times 52 times 5. Fourth year, it's going to be 90%, 80, the rate is going to be 8 pounds times 52 times 5, and year 5 it's going to be 95%, 80, there is no difference in the rate, 8 pounds, 52 weeks times 5. So let's calculate these numbers. 75 times 80 times 6 times 52 times 5, which is going to be 93,600. So likewise, let's calculate the remaining years. 116 480, 116 480, 149 760, 760, and the last one is 0.95 times 80 times 8 times 52 times 5, which is going to be 158,080. Okay, so these are the costs. Okay, now when you calculate the cash inflows and cash outflows to calculate the net present value, what you can do is you can take simply year 0, year 1, year 2, year 3, year 4 and year 5. So what you need to do is you need to take the cash outflow 500,000 here, investment. So year 1 your cash inflow is 364 minus 52,000. So what will be your net cash inflow? So 364,000 minus 52,000, which is going to be 312,000. 312,000. Okay. So year 2, 546 revenue minus 93,600. So 546,000 minus 93,600. How much is that? 452,400. So let's continue the calculation. 499,200. Year 3. Year 4, 542,880. And year 5 is going to be 632,320. 632,320. Now, in order to calculate the net present value, let's take the discounting factors here. So, discounting factor, the cost of capital is 10%. You are given, so year 1 is 1.909, year 2 0.826, and year 3 is going to be 0.751, year 4 683, and year 5 is going to be 621. So now let's take the discounted cash flow. This is 500,000 and here 312,000 times 0.909, which is 283,608, 283,608, and year 2 is going to be 373,682, year 3 374,899, 4370, 370, 787, 370, 787, and 392, 671. So when you take the net present value, this is the net present value, 500,000 negative, and these are positive cash inflows. Okay, so when you take the total, it's going to be 1,295,647. So this is the answer for the first part, where you need to calculate the net present value. So to calculate the net present value, you are given the revenue calculation and the cost. So when you calculate the revenue minus the cost, the running cost, so that will be your net cash inflows. So just incorporate the net cash inflows and discount it, and you will get the net present value of this particular project. So which is going to be 1,295,647. So therefore the net present value is positive. This is a feasible project. The second part, calculate the average rate of return per year of the project to build and operate the 5 new warehouses using the initial investment figure. Okay. Now we need to calculate the average rate of return. Okay. So let's move on to the next part. So I will erase this. Now let's move on to the second part. Calculate the average rate of return per year of the project to build and operate the 5 new warehouses using the initial investment figure. The initial investment figure is 500,000, and you need to identify the average profit over 5 years. Okay. Now we calculated from year 1 until year 5, we calculated our net cash flow, which is revenue minus the running cost excluding depreciation. Now which is 312,000 in the first year, second year 452, 400, then 499, 200, fourth year 542, 542, 880, and fifth year 632, 320. Okay, from this we need to deduct the depreciation amount. So depreciation per annum per year per warehouse is 20,000. So since we have 5 warehouses, which is going to be 100,000 per year. So what we need to do is we need to deduct 100,000 each year. Okay. So when you deduct 100,000 each year, then the net will be the net profit for 5 years. Okay. So which is going to be how much? 312. So here 212,000, 352,400, 399,200, 442,880, and here 532,320. So what is the total profit? Is going to be how much? It's going to be 1,938,800. Since we are calculating average rate of return, so what we need to do is this 1,938,800 is for 5 years, over a period of 5 years. So we need to deduct by 5. Then per year profit will be 387,760. Okay, so this is average profit per annum, and your initial cost is 500,000. This is the initial cost. So just divide by 500,000 times 100, which is going to be 387,760 divided by 500,000, 77.55. So this is going to be the average rate of return. So this is the answer for the part 2. Now let's move on to the third part. Calculate the payback period of the project to build and operate the 5 new warehouses. Okay. Now when you calculate the payback period, so what we need is the cumulative cash flows. Let's calculate the cumulative cash flows. Year 1, year 0, which is 500,000 negative, year 312 positive, year 2 452 400, year 3 499 200, year 4 542 880, year 5 632 320. So these are the net cash flows. So when you take the cumulative cash flow, which is 500 negative, 500 plus 312. So what is the net result? 500,000 minus 312,000, which is positive. So still we have a negative balance of 188,000. This 188,000 should be recovered from this 452 400. So this is a positive 264 400. Okay. So this became positive in year 2. So if you want to find out exactly how many years the payback period, so payback period should be 1 year plus the number of months from year 2. Okay, because this 188,000 is recovered from 452,400. So therefore what you can do is you can take the ratio 188,000 should be recovered from this cash flow 452, 400. Okay, so this is for the 12 months period. This is for the 12 months period. Year 2 means yearly cash flow. This is for the 12 months period. So therefore just multiply by 12. So you will get the exact number of months divided by 452, 400 times 12, which is going to be 5 months. So basically your payback period will be 1 year and 5 months. So this is for the part C.